Welcome to Guts and Guns.
Today, we're looking at the U.S. economy, and it really is a complex picture right now. You see financial markets hitting these incredible highs, record levels even. But then, you hear about households really struggling with costs, and there are these vulnerabilities maybe lurking beneath the surface. So our mission today is to unpack the latest U.S. economic health report, pull out the key insights from a bunch of different sources, and give you a really clear, nuanced view of where things stand and, well, where they might be going.
It really is a balancing act, isn't it? I mean, we saw this quite significant rebound in Q2 2025, which on the face of it sounds great.
Yeah.
But you dig just a little and you see these persistent inflation issues, the labor market shifting in funny ways, and frankly, some pretty serious structural fiscal challenges that we really need to pay attention to. It's definitely not a simple story.
Okay, so let's start with that big headline number. The report highlights this significant and welcome rebound in Q2. Real GDP grew at an annual rate of 3.0%. That's a big swing from the 0.5% contraction we saw before. So what's really driving that? What changed?
Well, what's fascinating, or maybe a bit misleading here, is that a huge part of that growth figure actually came from a big drop in imports. And yeah, consumer spending held up too. But the thing is, a decrease in imports boosts the GDP calculation, mathematically speaking. But it doesn't always mean our domestic economy is suddenly booming. It could just mean, businesses bought a ton of stuff last quarter before tariffs hit, or something like that.
Oh, okay. So it's not necessarily pure domestic strength.
Exactly. It can mask underlying, maybe, fragility.
That makes sense. And it ties into something else the report shows, which is really interesting. While that main GDP number was strong, real final sales to private domestic purchasers, which, is seen as a better measure of core demand, it actually slowed down. It went from 1.9% growth in Q1 down to 1.2% in Q2. Plus, investment and exports fell. So kind of mixed signals there. Although consumer spending itself, that was pretty broad, right? Covered services like healthcare, goods like cars.
Right. And that spending brings up the next big question, inflation. What's happening with prices in this picture? The PCE price index, that's the one the Fed watches really closely, it rose 2.1% in Q2. That's down quite a bit from 3.7% in Q1.
Okay, so easing pressure.
Somewhat. And core PCE, which takes out food and energy, that rose 2.5%, also down from 3.5%. But, and this is the key thing, both of those are still above the Fed's 2% long-term target. So it shows inflation is moderating, yes, but there's this stickiness, especially in core inflation, and that's definitely going to make the Fed very cautious about thinking about rate cuts anytime soon.
Okay, let's pivot to the job market then. The reports for June 2025 looked strong, at least on the surface. Unemployment held at 4.1%. Employers added 147,000 non-farm jobs, which was actually better than expected. So what does that really mean for the average worker? Is the job market genuinely healthy?
Well, this is where it gets really interesting and maybe a bit confusing. You have this split. The official Bureau of Labor Statistics, the BLS, reported those job gains you mentioned. But ADP, which tracks just the private sector, they actually reported a loss of 33,000 jobs in June, particularly in areas like professional services and healthcare.
So a loss in private jobs.
Yeah. And the implication there, the really critical insight for you, is that strong public sector hiring, like government jobs, might be hiding a slowdown or even a shrinkage in the private sector. And typically the private sector is really the engine for long-term growth and opportunity. Looking forward, the CBO, Congressional Budget Office, they actually see unemployment gradually climbing a bit, maybe to 4.4% by late 2027.
And what about people actually in the workforce? The participation rate, it was 62.3% in June, which is down slightly and still way below, like 5 percentage points below where it was back in the early 2000s. Plus, there's this possibility that U.S. net migration could actually turn negative this year for the first time since the 60s. So what happens if the labor supply is shrinking or just not growing?
Well, from a bigger picture perspective, a shrinking or even just stagnant labor supply puts fundamental upward pressure on wages and therefore on inflation. It's basic supply and demand, right? Fewer workers available means companies have to compete harder, pay more. Even if AI gives us some productivity boost down the line, if you just don't have enough available workers, it limits how much the economy can grow without sparking more inflation. It's a real structural constraint.
Okay, but on the flip side,
Sure.
for those who are working, wages seem to be doing better. Median weekly earnings for full-timers hit $1,196 in Q2. That's up 4.6% from last year. And that definitely beats the CPI increase of 2.4% over the same time. So real wage gains.
Yeah, that's a positive sign. And you have to ask, will it last? The Indeed wage tracker showed things maybe cooling a tiny bit in June, down to 2.9% growth. But generally, wage growth is still running ahead of inflation, which was 2.7% in June. So something like 57% of workers actually saw their pay beat inflation in June. That's way better than back in 2022. And we're also seeing maybe some signs that wage growth is becoming a bit more even across different income levels, which is potentially good news too.
Any specific industries we should watch in the job numbers?
Yeah, a couple of things stand out. Construction added about 15,000 jobs in June. That's probably seasonal, maybe some infrastructure spending kicking in. But manufacturing actually lost 7,000 jobs. And the manufacturing PMI, that index that measures activity, it's been in contraction territory for like 30 out of the last 32 months. So manufacturing is definitely struggling. Oh, and that initial big rush for AI-related hiring, it seems to be cooling off a bit. Companies seem to be shifting now from just hiring lots of people to actually figuring out how to use the AI they have, more integration, less pure headcount.
Right, shifting focus. Okay, let's dig into consumer costs then. The CPI, the main inflation measure, was up 2.7% over the year ending in June. Core CPI, without food and energy, was up 2.9%. So what's the story behind those numbers? What are people actually paying more or maybe less for?
It's really a mixed bag, you know. Overall, food prices were up 3.0%, groceries to food at home up 2.4%. But eating out, food away from home, that was up 3.8%. And some specific items, wow, eggs up 5.6% in June, and the USDA is forecasting a huge jump, almost 25% for the whole year because of avian flu.
25%? Wow.
Yeah, and beef and veal up over 10% compared to last year. Expected to rise almost 9% for the full year. Tight supplies there. But here's a little bit of good news. Fresh vegetable prices were actually down 1.3% in June compared to last year.
Okay, so some relief there, but ouch on the eggs and beef. What about energy?
Energy has actually helped pull the overall number down a bit. The energy index fell 0.8% over the year. Gasoline was down 8.3%. The national average was around, $3.13 a gallon mid-July?
Yeah, noticeable drop at the pump.
For sure. But that relief is partly canceled out by other energy costs. Electricity prices went up 5.8%, and piped natural gas, that jumped significantly, 14.2%. So maybe cheaper to drive, but potentially more expensive to, eat and clean your house.
And other big ticket items for households?
Shelter costs, always a big one, up 3.8%. Rent and what they call owner's equivalent rent, both up similarly. Transportation services also rose 3.4%. And a big driver there was motor vehicle insurance, up a pretty steep 6.1%.
Yeah, car insurance seems to be hitting everyone.
It's like that stealth inflation you mentioned. The car payment might be steady, but the insurance keeps climbing.
Exactly. Now, here's something the report flagged: trade tariffs potentially adding to inflation, maybe a passing bump. How does trade policy actually filter down to these costs we're talking about?
Well, if you look at the bigger picture, customs duties, the money collected directly from tariffs, they jumped 32% in fiscal year 2025 so far. That shows you the direct link. Tariffs are basically a tax on imported goods. And very often, that tax gets passed along to businesses and then ultimately to you, the consumer, in the form of higher prices. So continued uncertainty about trade policy, or if more tariffs get put back on, that could definitely create ongoing inflation pressure, not just a passing bump, especially for anything imported or things made with imported parts.
Okay, let's shift gears to housing. It's such a huge cost. The report says the market is in transition, moving towards more balanced conditions. What does that actually look like on the ground?
What's striking is the national median home sale price. It only went up modestly, about 1.34% year over year, reaching $422,800 in May. But at the same time, the number of existing homes being sold actually fell, down almost 2%. So prices are inching up, but fewer deals are happening. It suggests buyers might be getting more cautious, maybe feeling pinched elsewhere.
Right. And affordability is still a massive issue, isn't it? The median monthly payment, just principal and interest, jumped over 10% year over year to nearly $2,200 in April. How does the payment go up that much if prices only nudged up a bit and mortgage rates have been relatively stable around, say, 6.7%?
Yeah, that's a really important question. Why the big jump in the payment? It strongly suggests that other costs tied to owning a home are likely going up quite a bit. Things like property taxes, homeowners insurance. Those are adding significantly to the monthly burden. Plus, you have all these homeowners who locked in super low rates years ago. With current rates higher, they're just not moving. They're staying put. and that keeps the supply of existing homes lower than it might otherwise be.
The lock-in effect. So what does that mean for overall inventory then? The report does say things are normalizing a bit. New listings are up almost 10%, total inventory up over 20% from last year. Over 1 million homes available nationally now, first time since late 2019. Sounds like maybe good news for buyers.
It is, gradually. In the bigger picture, yeah, more supply means buyers are starting to get a little more negotiating power back. Nationally, something like 40% of homes are selling below the asking price now, and about a third of sellers have cut their price. That definitely signals a less frantic market than, say, a year or two ago. But it really varies by region. You look at a place like San Francisco, they still have major inventory shortages, so you end up with this kind of two-tiered market across the country. Some places cooling, others still really hot.
Okay. And what about the rental market? Is that following the same pattern?
Actually, no, it's behaving quite differently. The national median rent in June was around $1,400. That's actually down 0.7% from last year and almost 3% below the peak back in 2022. And vacancy rates, they climbed to a 15-year high, over 7% in the first quarter. A big reason for that was this huge wave of new apartment buildings finishing construction, like 600,000 new units came online last year.
Wow, that's a lot of new apartments.
It is. Now, forecasts do suggest rents might tick up a bit for the rest of 2025, maybe ending the year up in the high 2% range nationally once that big supply wave gets absorbed. But the key takeaway here is that this easing in rents could eventually help bring down that shelter component of inflation, which has been really stubborn.
Okay, let's turn to Wall Street. Financial markets have been incredibly strong. S&P 500, NASDAQ, Dow, all hitting new records this year. What's fueling all this optimism? Is it just momentum, or is there solid footing underneath it?
Well, what's striking is that the gains haven't just been in one area. You're seeing strength across different sectors, industrials, tech, communication services. It seems buoyed by some of the positive economic data we talked about, maybe some optimism that tariffs wouldn't get worse or might even ease. And certainly that huge spending by big tech companies on artificial intelligence has been a major factor, boosting those stocks and contributing to this idea of future productivity gains.
But it feels like sentiment can turn on a dime, right? Like on July 30th, the market got nervous, that risk-off mood, just because U.S. and China trade talks didn't produce a big deal. What does that sensitivity tell us?
Yeah, it raises a really important question about vulnerability. It's possible the market, in hitting these record highs, is pricing in a perfect scenario. Inflation cools perfectly, growth stays okay, trade tensions ease, and that might mean it's underestimating some of the real risks still out there. Any bad news, especially on trade, or maybe if the Fed signals it has to stay tougher for longer, that could definitely trigger a pretty sharp correction. Also, regarding AI, yes, companies are spending billions and it's driving stock prices. But the big question, the multi-trillion-dollar question maybe, is how and when do they actually make money from AI? The monetization piece is still unclear. And like we said, the hiring frenzy has cooled a bit as they figure that out.
Okay, shifting from markets to the government's books. Fiscal health. The U.S. is facing some pretty daunting challenges here. The federal deficit is estimated at $1.9 trillion for this fiscal year, and the national debt is projected to climb from 100% of GDP now to 118% by 2035. That's higher than even after World War II. What's driving this massive debt accumulation?
Well, connecting it to the bigger picture, government spending federal outlays is projected to keep rising as a share of the economy, from about 23.3% of GDP this year to 24.4% by 2035. The main drivers. It's the rising costs of Social Security and Medicare as the population ages. And critically, the escalating cost of just paying interest on the existing national debt. As rates go up, that interest payment gets bigger and bigger. It's already gotten to the point where the Treasury Department is using these extraordinary measures just to avoid hitting the official debt limit of $36.1 trillion. They expect those measures to run out sometime in August or September.
So it's like juggling bills to avoid default. Where is the government actually getting its money from right now?
Well, collections are actually up. Year to date for fiscal 2025, the government took in about $4 trillion, which is up 7%. Individual income taxes are the biggest chunk, over half, 51.4%. But here's that tariff connection again. Customs duties are up a huge 32%. That's a direct result of the tariffs imposed since February. So it really highlights that complex trade-off. Tariffs bring in revenue for the government, yes, but they also increase costs for importers, which usually means higher prices for consumers, adding to inflation.
Right, revenue with the side effect. And what about tax policy itself? There was that recent bill.
Yeah, the One Big Beautiful Bill Act, back in July. It basically extended a lot of the tax cuts from the 2017 law. It made the 7 tax brackets permanent, increased the standard deduction like to $30,000 for a married couple filing jointly. And it also raised the limit on deducting state and local taxes, the SALT deduction, up to $40,000 for married couples, though there are income limits. So the goal there is tax relief for many individuals and families. But the flip side is these kinds of changes likely add to that long-term federal deficit problem we were just talking about.
Okay, let's broaden the view again. How is the U.S. economy fitting into the global picture, especially with all the talk about trade barriers and uncertainty worldwide?
What's really striking is how sensitive things are. Yes, some specific tariffs were paused temporarily, but that fragility was clear when those U.S.-China trade talks didn't result in a big comprehensive deal in late July. The market reaction here was immediate, that risk-off mood we mentioned. Now, the IMF did slightly upgrade its forecast for global growth, but interestingly, part of their reasoning was that businesses were stockpiling goods early because they expected U.S. tariffs. So even the upgrade had a cautionary note, and both IMF and the World Bank are pretty clear. The risks to global growth are mostly on the downside. Things like more trade fights, policy mistakes, geopolitical tensions.
So amidst all that global uncertainty, what's happening with the U.S. dollar had that huge plunge, right? Down 11% in the first half of 2025, the biggest drop in decades. But lately, it seems to be strengthening again. What's driving that back and forth?
Yeah, this raises a really crucial point about the dollar's contradictory moves. It's like this constant tug of war. On one side, you have these long-term structural factors that tend to weigh the dollar down, like the U.S. consistently buying way more from the world than it sells. That's the current account deficit, $450 billion just in Q1. And the fact that the U.S. owes a massive amount to the rest of the world, that negative net international investment position of nearly $25 trillion. Foreigners own much more U.S. stuff than Americans own foreign stuff. That should weaken the dollar over time. But then on the other side, you get these short-term things that push it up, like strong U.S. economic data relative to other countries, or when there's global turmoil, investors flock to the dollar as a safe haven. So where the dollar goes from here is super important. It affects import prices, company profits, everything.
So putting it all together as we look ahead, what's the consensus outlook for the U.S. economy? What should listeners kind of brace for or hope for?
The general projection is for moderation. A slowdown, but hopefully not a recession. The CBO sees growth easing to 1.9% this year, 1.8% next year. Inflation is expected to keep drifting down, eventually getting back to the Fed's 2% target, maybe by 2027. Although the IMF is a bit more cautious, warning it could stay sticky above target for longer. And unemployment, as we said, is expected to tick up modestly, maybe reaching 4.4% by late 2027. So a gradual cooling is the main forecast.
Which puts the Federal Reserve in that really delicate balancing act.
Absolutely. They're walking the tightest of tightropes. They need to keep policy tight enough to ensure inflation really does come all the way down to 2%, but they're also facing political pressure and the economic risk that if they keep rates too high for too long, they could tip the economy into a more serious downturn. Cutting rates too soon risks inflation flaring back up. Waiting too long risks recession. That fog of economic uncertainty everyone talks about. A lot of it really centers on whether the Fed can navigate this perfectly. Can they achieve that soft landing?
Right. And beyond just the Fed's actions, what are the biggest risks and maybe opportunities out there that could push things one way or the other?
Well, the risks are pretty clear. Escalating trade tensions are a big one. That sticky core inflation proving harder to tame than expected. The growing federal deficit and debt. Supply-side issues, too, like maybe slower immigration, limiting the workforce, and just general geopolitical instability around the world. But there are definitely opportunities, too. AI is the big one. If its adoption really does lead to widespread productivity gains, that could be a powerful force offsetting some of these headwinds. We also still have pretty resilient consumer demand. Corporate earnings have held up well, and there's always the potential for trade tensions to ease, which would be a significant positive.
Okay, so to wrap up this deep dive, it seems the U.S. economy is showing resilience, yes, but the growth is definitely uneven. We had that strong Q2 headline GDP, mostly thanks to consumers, but underneath you've got a complex job market, core inflation that's still sticky, and these really significant fiscal challenges looming. And the financial markets, they're optimistic, hitting records, but clearly very sensitive to any potential shocks, especially around trade or Fed policy.
Yeah, if you take that wider perspective, the key areas we really need to watch are how exactly the Fed manages this inflation fight, how the labor market evolves, especially that split between public and private sectors, and the longer-term demographic shifts. Can we get on a path of fiscal sustainability? Can trade policy become more stable and predictable? And can we really harness technologies like AI to boost productivity across the board? Those are the big questions.
It really points towards needing flexible policies, smart investments in things like AI and infrastructure, maybe more fiscal discipline, staying engaged globally, and figuring out how to support consumers without overheating things.
Which leads me to a final thought, maybe a question for you, the listener. We've talked about this intricate balancing act the U.S. economy is performing right now. Thinking about everything we've discussed, inflation, jobs, debt, trade, technology, what single factor do you believe will be the most decisive, the most influential in shaping the economy's path over the next year, and why that one?
We hope you enjoyed this week's episode. Tune in again.